Hi, it's Don Thornton, and I want to go over a very important point that if you're doing real estate investing, especially with foreclosures and short sales, that you need to know what happens in a short sale if the property, let's say that the property sells at 150, the mortgage amount was 200. What happens to that $50,000 that was forgiven? Because usually the mortgage company will forgive the debt, and this is directly from the IRS. I'm going to have this available in my group, my group where I teach my students how to do this. If you're interested in finding out more about how to get involved in that, reach out to me, and I'll be glad to talk to you more about how to come in on board to learn all this stuff. But basically, whenever a debt is canceled, they're going to give you a 1099, okay, which is right here. So this is what a 1099 looks like. You get this at the end of the tax year, okay? So basically, when you get this, you have to file it. You have to give it to your tax preparer, and it has to be filed with your tax return for that year, okay? So a lot of people say that, well, I don't want to do a short sale because then I'll get a 1099. And what they don't realize is you're going to get the same 1099. Let's say, for example, if the homeowner lets the property go to foreclosure auction, and an investor like myself buys it at the auction, and let's say the same scenario, the seller, the investor buys it at 150 on the auction, and there's still $50,000 left over because there's $200,000 owed on the property, then the homeowner is still going to get a 1099. Okay, so let's say that the homeowner says, okay, well, I don't want to do that. I'll just do a deed in lieu of foreclosure, and that way I'll avoid getting a 1099. No, you get a 1099 too. You get it regardless. Okay, so what happens then is that if you do a deed in lieu of foreclosure, the mortgage company will take the property. They will become the owner of the property because you've deeded it over to them. They will put it up for sale, and when someone buys it, and it may be a year, 2 years, or whatever, but eventually someone's going to buy it, and let's say they buy it for 140. Okay, well, the more amount of the mortgage is 200, so that's $60,000 worth of debt cancellation. So then, let's say 2 or 3 years later, you've forgotten about the house, you think you've moved on. All of a sudden, you get in the mail the first part in January of the following tax year, you get a 1099 for $60,000. So that's going to be a surprise. Not many people know about that or understand it, and there's some really bad surprises coming to them if they make that poor decision. So getting back to this, obviously you have to. The IRS is very simple. In general, you must report any taxable amount of a canceled debt as ordinary income. Okay, so there's two ways, and again, I am not a tax preparer, I'm not a tax authority, I am not a certified public accounting. Make no claim to be. I am merely passing on information that comes directly from the IRS itself. Okay, so there are exclusions to this. Okay, and this is very important. If someone has filed a Chapter 7 bankruptcy, the bankruptcy was discharged, then it is any mortgage amount that is forgiven for a property that was included in a bankruptcy, that is not considered income. So anyone who if you come out of a bankruptcy, if you talk to someone that has come out of a Chapter 7 bankruptcy and they're worried about, well, I don't want to do a short sale because I'm going to end up owing on the property. No. Well, then I'm going to end up owing taxes. No. Right here, you can show them this. You can show them this form here, and you'll see that if its debt is canceled in Title 1 of the bankruptcy case. Title 11, it doesn't mean Chapter 11. I mean this just covers all the bankruptcies. Okay, that's what it means. And then the second of all is let's say that someone did not file a Chapter 7 bankruptcy, and therefore you can't, that they are, liable for, that's considered taxable income. However, Debt can also be canceled due to extent of insolvence. Extent insolvent, okay? To the extent insolvent. So you need to talk with a tax professional, an educated, licensed tax professional to show this. However, as far as I know, and what my CPA has told me is that if you look at the amount of that you're in the red for a year as opposed to what your income is, inflow, then you're a good tax preparer can show the IRS that for that tax year when this occurred, then you are insolvent, and therefore that amount of canceled debt or ordinary income will then basically can be taken away and not being counted against you for your taxes. Okay. I can tell you that in 18 years of doing this, I have never once had any of my clients come back to me and tell me they had issues about owing taxes when a short sale was done. Now, again, full disclosure, having said that, I have recommended that they talk to my CPA, and my CPA has been very good about, acting as a third party authority to tell them that, because I'm not going to tell them that and get on the hook for a possible lawsuit if someone misunderstands or whatever. I refer them to my tax authority, to my tax professional. So, but I just want you guys to know that you have this that you can show anyone, and obviously you must tell them that they need to get specific advice from a tax professional, not from you. However, you can show them this because this is directly downloaded from the IRS site. Okay, hope that cleared things up about 1099s and how it is affected by bankruptcy and so on and so forth. Okay, thanks.